Listen, I want you to imagine it's a Monday morning in early 2026. You're sitting there with $5,000 in your brokerage account. You look at the charts and the market is at an all-time high. Again, you remember the volatility of 2024, the scares of 2025, and you think to yourself, if I buy right now, am I just buying the top? Should I wait for the big one? Should I wait for that 20% dip everyone on social media is talking about? This is exactly the analysis paralysis our friend Mark is facing today. Mark has some extra cash and he is terrified of making the wrong move. He's torn between two worlds. On one side, he hears about dollar cost averaging, the slow, steady, almost boring path. On the other side, he hears the sirens of buying the dip. The strategy of the market sniper who waits for the perfect moment to strike. In this video, we are going to end this debate once and for all. We're going to look at some fascinating research involving 5 different types of investors. We're going to run a fictional simulation of Mark's own choices, and we're going to dive deep into the investing psychology that actually determines whether you end up rich or broke in 2026. By the end of this journey, you and Mark will know exactly when to hit the buy button, and more importantly, how to sleep soundly at night while you do it. Let's get into the numbers. Let's start with the strategy that feels like a set it and forget it machine, dollar cost averaging, or DCA. Mark decides to try this out. Every single month on the 15th, regardless of what the news says, regardless of whether the market is up or down, Mark buys $500 worth of his favorite ETF. The beauty of DCA in a year like 2026 is its mechanical nature. When the market is expensive, Mark's $500 buys fewer shares. When the market has a bad week and prices drop, that same $500 buys more shares. Mark is essentially averaging his cost over time. He realized that DCA is for the investor who values peace of mind over beating the system. He doesn't have to check the charts. He doesn't have to listen to the experts. He just becomes a consistent buyer of the American economy. But Mark wonders, am I leaving money on the table? If I just waited for a crash, wouldn't I be much richer? So Mark looks at the alternative, buying the dip. This is the strategy where you keep your cash in a high-yield savings account and wait for the market to stumble. In 2025, Mark tried this. He held onto his cash, waiting for a 10% drop. But the market just kept grinding higher. He watched from the sidelines as the S&P 500 went up 15% while he was earning a few pennies in interest. By the time the dip finally came, the price was still higher than it was when he first started waiting. This is the hidden trap of buying the dip. It sounds smart, it sounds like you're getting a bargain, but Mark realized that to be a successful dip buyer, he had to be right twice. He had to know exactly when to get out and exactly when to get back in. Mark found himself staring at his phone at 2 a.m., checking futures, trying to predict the next interest rate move. He was stressed, he was anxious, and he started to ask, is the extra profit, if there even is any, worth the loss of my mental health? To find the answer, we ran a simulation for Mark. We created 2 versions of him, Mark A, the DCA machine, and Mark B, the dip hunter. We gave them both $12,000 a year to invest over a volatile period. Mark A, the DCA King, he invested $1,000 every month like clockwork. During the mini crash of late 2024, he bought shares. During the AI surge of 2025, he bought shares. Mark B, the dip hunter, he saved his $1,000 a month. He waited for a 10% drop. He finally saw one in mid-2025 and pounced. The result? Mark A, the boring DCA investor, actually ended up with more money. Why? Because Mark B's cash sat on the sidelines for 8 months doing nothing. Even though he bought at a cheaper price during the dip, he missed out on the dividends and the growth that happened while he was waiting. Mark B bought a bargain that was still more expensive than Mark A's average price. Mark A's money tree started growing on day 1, while Mark B was still looking for the perfect soil. Now, Mark is a skeptic. He said, that's just one example. What does the big data say? So we looked at a famous study by Charles Schwab that tracked 5 different investment strategies over 20 years. This study is legendary. It compared 1, perfect timing, the person who invested at the absolute lowest point every single year. 2, invest immediately, the person who put their money to work the second they had it. 3, DCA, the person who split their money into 12 monthly chunks. 4, bad timing. The person who invested at the absolute peak every year. Stay in cash. The person who never invested because they were waiting for the perfect time. Here is the shocker that changed Mark's life. The difference between perfect timing and invest immediately was surprisingly small. Over 20 years, the person who just put their money in right away was almost as rich as the person who had a crystal ball. But the real lesson? The person who stayed in cash, waiting for the dip, they ended up with less than half the wealth of the bad timer. Mark realized that even if he was the unluckiest investor in the world, and always bought at the top, he would still be light years ahead of the person who sat on the sidelines. At this point, Mark had a eureka moment. He asked, what if I don't have to choose? What if I can be a consistent investor and a sniper? This is the 2026 strategy. Mark decided to automate 90% of his investing through DCA. He has his monthly VOO or SCHD purchase set to autopilot. This ensures he never misses the time in the market. But he keeps a small opportunity fund, maybe 10% of his cash. This is his fun money. If the market has a bad week, if there's a headline that scares everyone else, Mark uses that opportunity fund to buy the dip. This gives him the best of both worlds. He gets the mathematical certainty of DCA and the psychological satisfaction of getting a deal during a dip. He's no longer afraid of a crash. He's actually excited for one because he's already in the game and has a little extra ammo ready. Looking back at his journey, Mark realized that investing isn't a math problem, it's a temperament problem. In 2026, information is everywhere. You can see your portfolio value every second on your watch. This makes buying the dip even harder because when the dip actually happens, it feels like the end of the world. Mark realized that when the market drops 10%, most people who said they were waiting to buy the dip actually get scared and do nothing. They wait for it to go lower. And then they miss the recovery. DCA removes that fear. It takes the decision out of your hands. It forces you to buy when you are scared, which is exactly when the best wealth is created. Mark stopped trying to be the smartest person in the room and started being the most disciplined person in the room. The data is clear. Time in the market beats timing the market. Whether you use dollar cost averaging or a hybrid strategy, the most important thing is that your money is working for you, not sitting in a bank account losing value to inflation. Mark finally understood that his money tree needs time to grow. Every day he waits for a dip is a day of growth he can never get back. But now that Mark has his strategy locked in, now that he knows how to buy, he's facing the next big question. He has $50,000 ready to go into the market using his new DCA plan. But where should he put it? Should he put it into the growth engine of VOO, or should he focus on the income fortress of SCHD? This is the ultimate showdown for any serious investor in 2026. To help Mark decide, I ran a brutal 18-month head-to-head test with $50,000. I looked at the total returns, the dividend growth, and exactly how much freedom each one provided. If you want to see which ETF wins the battle for your $50,000, you have to see the results. Click the video on your screen right now, what happens when you invest $50K in VOO versus SCHD, and let's find out where Mark is putting his money for the long run. I'll see you there.